You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. I'm your host, Mark Benzaquen. It's interesting in that when our investor education team here at OIC talks with investors or advisors about options and whether or not they use options as an investment vehicle, the ones that don't often say that one of the reasons they're not using options is because they feel options are too risky. And while it's true that in many situations, investors using options can lose up to 100% of their investment, it's also true that due to the versatility of options, investors can employ strategies specific to risk reduction. And that's where we're going to begin today's discussion. Let's start with a scenario in which an investor is bullish on our favorite hypothetical stock, XYZ, and owns 100 shares. Being bullish, the investor is forecasting increasing share prices, but with an eye to an upcoming earnings announcement or some other release of news that might have a negative effect on share prices, the investor is also cautious and looks to protect their holdings. So with this scenario in mind, what might the investor do to protect their stock? One route they might take could be to place a stop-loss order on the shares, which would be triggered once share prices fall below a specified price. However, stop-loss orders typically do not guarantee an exit price for the stock. They simply sell the shares at the market once prices fall below the stop-loss price. Or if the investor uses a stop-loss limit order, they may have a guaranteed price but no guarantee that the order will actually be filled, and they may find themselves sitting on shares declining in value. While both stop-loss orders do have their benefits, for example, both can typically be entered into at no cost and without an expiration date, they also have their shortcomings in that in either case, the investor is not in control of either the exit price and or the execution of the stock sale. Due to the flexibility and versatility of options, investors do have another route. If we look back to our Options 101 days, we're reminded that put holders have the right to sell stock at their strike price. For investors long stock, incorporating a long put option offers not only a guaranteed exit price, but also empowers the investor with the ability to control and the decision-making ability of when or even if to sell their shares. Looking back to our now bullish but cautious investor, let's further assume that though they want to own the shares, or I should say they want to continue owning the shares, they are willing to sell if this upcoming news results in share prices dropping beyond 10%. If stock is currently trading $100, a 10% decrease would be $90. So if shares drop below $90, the investor wants out. By purchasing a 90 strike put, or any strike for that matter, the investor is selecting an exit price at which they are able to sell their stock. If shares were to fall below the strike, the investor can elect to exercise and sell their stock at that strike price. For many investors, being in control is what differentiates the protected put, as the strategy is known, from the different types of stop-loss orders. With the protected put, the investor can decide when, assuming an American-style option, or even if, to exercise. What if share prices rebounded from below 90 back up to 105 or more in the coming weeks? With the stop-loss, it's likely that the investor would no longer own the shares and therefore won't participate in the pricing rebound. For the put holder, if they forecast that the dip in share price is only temporary, they may elect to hold on to the stock until expiration and decide on a course of action at that time. Of course, these rights do come at a price, namely the premium paid for the option. Let's assume that the 90 strike put is trading for $1.50 per contract, or $150 once the multiplier is factored in. This $1.50 would then be subtracted from the exit price to determine the actual selling price of the stock, which would then be 88.5 in this case. Should the investor choose not to exercise, meaning if shares didn't fall far enough to warrant exercise in the eyes of the investor, this $150 would be lost. Oftentimes, this loss might even be welcomed by the protected put holder, as their end game is not necessarily to sell the stock, but rather to hold it and benefit from increasing share prices. In other words, the put is simply there to protect in a worst-case scenario, that of falling share prices. In an ideal world, the protection offered by the put is actually never even needed. As I mentioned earlier, options can be versatile. To this point, puts can protect against falling share prices in a single stock. They can also be used to protect an overall portfolio. Let's look at another example. And in this one, we'll assume that an investor has a $1 million portfolio and that the composition of that portfolio mirrors one of the broader-based indices. If we further assume that our investor is looking to protect against a more than 10% decline in the market, they might look to a 10% out-of-the-money put in a security that also mirrors the index. Assuming that such a security exists, say as an exchange-traded fund or ETF as they're commonly known, the investor might look to buy out-of-the-money puts for protection. So now let's get to some math. 10% of $1 million is $100,000. So the assumption is that the investor is willing to accept a loss of no more than $100,000 on their $1 million portfolio. If the market drops below this point, the investor is looking to liquidate their remaining $900,000 in holdings at a price of their choosing. If the ETF is trading for $100 a share, a 10% out-of-the-money put would equate to a $360 strike, which has $36,000 worth of notional value due to the multiplier. 900,000 divided by 36,000 leaves us with 25, meaning the investor would need to purchase 25 of the 360 strike puts in order to protect $900,000 worth of holdings. If each put were trading for a quoted price of $2, 25 puts would amount to $5,000, which is the cost of protecting the portfolio. This $5,000 would also be the amount the investor would have at risk should the protection not be needed. If the investor were looking for a way to protect their stock but at a potentially reduced price, they might look to incorporate a short call into the mix and turn the protected put into what's known as an options collar. Typically, stockholders sell calls against their shares in order to receive premium derived from the call sale, thus generating additional returns on their long stock. In this case, however, the premium received from the short sale is used to offset the cost of the protection afforded from the long put. In some cases, the short call premium might completely offset the cost of the put. Of course, selling calls has their own unique set of risks, and in this case, the trade-off is that the investor is reducing their upside profit potential. Again, looking back to our Options 101 days, selling calls obligates the seller to deliver stock at the strike price if assigned. This means that if shares were either to rebound or rally past that short strike, the stock the investor was looking to protect must then be sold at the strike and delivered to the call exercise. Let's look back to our early example. Stock is trading $100. The investor purchases the 90 strike put for $1.50, enabling the investor to sell shares at $90 should they so choose. To pay for the put, the investor also sells a $108 strike call, trading at a quoted price of $1.50 as well. The resulting position is long 100 shares of stock for $100, long a $90 strike put, and short a 108 strike call, with the option position enacted for no cost beyond commissions and fees, etc. In terms of resulting rights and obligations, the investor now has the right to sell stock at an exit price of $90, but is also obligated to sell those shares at 108 upon assignment. If share prices don't decline below $90, it's likely that the investor will not exercise their right to sell and will continue to hold their stock. If share prices do not eclipse the 108 mark prior to expiration, it's likely that the short call will expire unexercised and the investor continues to hold their stock. And as the trade was enacted for no cost, or what we call even money, there will be no loss from the options position aside from the commissions or fees incurred when enacting the trade. It should be evident the balance between strike selection of the put and the call is a delicate one. The put strike will be the exit price of the stock, and therefore it's logical that the higher the strike or exit price, the higher the cost to purchase. In order to offset this cost, we look to the short call, and remembering that the short call strike is the price at which we're willing to have the shares called away. The higher the strike, the higher the called away price and lower the premium received. If the investor were looking to obtain protection at little to no money, they'll likely need to sell a call at a strike that may not be equidistant to the put, meaning a 10% out of the money put and a 10% out of the money call. Due to a concept known as volatility skew, it's likely that the out of the money put is priced higher than the equally out of the money call, necessitating the investor to choose a lower strike call in order to pay for the protection they desire. This is where the balance comes in, as the lower strike call, while it generates higher premium to balance out the cost of the put, it also requires the investor to relinquish their shares at lower prices, and lower prices than they might which otherwise choose. And with that, ladies and gentlemen, we're just about out of time. So I want to thank you all for listening and supporting us in our Wide World of Options series. And I hope that you were able to take some useful information away about the potential protection afforded by using options. Before I sign off, I want to invite you to register for my upcoming OIC webinars, which will take a closer look at these various strategies designed for protection, including a deeper dive into the concepts that we discussed today. You can register on OIC's website at www.optionseducation.org to attend the live presentation or to view it on demand. And as always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. Thanks again to all those listening, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.